So, what is the stock market? Well, the stock market is just a place where shares of U.S. companies are publicly traded on the New York Stock Exchange. Now, let's say an average Joe wanted to invest in the stock market. Off the bat, the stock market can seem very intimidating to him, but it's actually not as complicated as he may think. Just think of a stock as a small piece of the company. So if he buys a stock, he is now a shareholder within the company and has a vested interest in how it performs. However, there are a number of factors that can cause a stock price to move up and down. For example, if a company is doing well, profits are increasing, or the overall market is up for the day, then more people will want to buy the stock, causing the price to go up. On the other hand, if the company has had a bad earnings report, doesn't meet investors' expectations, or the overall market is dropping, then there will be more sellers than buyers, causing the stock price to go down. These are basic laws of supply and demand. If Joe wanted to buy stock, he can only buy from publicly traded companies that are listed on a stock exchange. Each of those companies have a ticker symbol by which they are traded. For example, Apple's ticker symbol is AAPL. So, if Joe wanted to buy one share of Apple trading at $100, he would type in AAPL on his online trading platform and click the buy button. But before Joe selects what stock to buy, he needs to get an understanding of the overall stock market and how it all works. First off, the stock market is comprised of over 10,000 public companies whose stock are actively traded on the New York Stock Exchange. Because companies can vary in size and represent different parts of the economy, it's hard to gauge how well the overall stock market is doing by looking at all 10,000 companies. Therefore, stock market indexes were created to give investors a better snapshot of how the overall market is doing. These indexes act like barometers and tell us how hot or cold the market is. Two of the most widely used stock market indexes are the Dow Jones 30 Industrial Average and the S&P 500. The Dow Jones is the one that most people are familiar with, and what you hear on TV all the time. It's comprised of the 30 largest U.S. companies, including Apple, McDonald's, and Walmart. So, why would this index be useful to Joe? Well, there's a very famous saying, the tide lifts all boats. So for example, if the Dow Jones 30 index is up 100 points for the day, then there's a good chance Joe's stock went up as well. Likewise, if the Dow Jones drops, there's also a high probability that his stock also went down. This is why people look at the stock market indexes. It gives them a good idea of how well their stock is doing. The other index is the S&P 500, which is a more accurate indicator. It gives you a clearer picture of how the overall stock market is doing when compared to Dow Jones 30. The Dow Jones tracks 30 U.S. companies. However, the S&P tracks 500 of the largest U.S. companies, and they represent all parts of the economy. It is what all professionals around the world look at and is considered the benchmark index that money managers and investors base their performance against. Because of this, going forward, I'll only refer to the S&P 500 when talking about the markets, and so should you. In the next video, I'll talk about the S&P in more detail, all the stocks within it, and all the sectors they are divided into.